Welcome to Illuminati Silver. We tell the truth about silver. Today is Wednesday, the 9th of March 2022, and we're publishing the full version of an interview conducted with Mr. Josh Saul, the CEO of the Pure Gold Company, last Friday. On Monday, we published part 1 of the interview, and yesterday, part 2. And today, for those who've seen neither, we've published the full version. In this interview, we discuss Josh's business, why gold and silver are important for wealth preservation, the interrelationship with other investment vehicles, the gold and silver ratio, and why silver should be $100 an ounce, even with gold at current price levels. We also cover issues such as tax efficiency and why precious metals over the coming years will become increasingly important, desirable, and in demand. The interview is packed with useful information, especially as the Pure Gold Company has clients around the world. And for those interested, we've included a link in the description box below, as well as in the comment section of each of the previous videos we have published. So without further delay, let's go to that all-important and revealing interview. Welcome to Illuminati Silver. We tell you the truth about silver. Today is Friday, the 4th of March, 2022, and it's 3 p.m. in the afternoon. And I'm delighted to have Mr. Josh Saul, the CEO of the Pure Gold Company, with us today to tell us about his business and what makes them particularly unique. But first, I'd like Josh to tell us a little about himself. Josh, good afternoon to you.
Good afternoon. Thank you very much for having me.
Tell us about you and then about your business, Josh, just so our members can get a sort of flavor as to what you're all about.
Perfect. I'll do my best.
Thank you.
So I trained as a lawyer back in the day before becoming a financial analyst, analyzing metals and mining and various companies across that sort of sector. And that then took me to getting involved in the physical market. I ran a brokerage within the UK for a few years before setting up the Pure Gold Company in 2012. I live in London. I have 2 young children, happily married. And as much as I like to involve myself in all things gold and silver, I also like to travel. I like to read, and I like to educate myself in terms of what is happening within and around the world, and how we are able to proactively make a difference and make a change, both for ourselves and society.
That's great. Thank you, Josh. The Pure Gold Company, what is it and what do you actually do?
So the Pure Gold Company is a company, a physical gold and silver brokerage with a particular emphasis on investment. So we sell physical bars, gold bars, gold coins and silver, platinum and palladium. We either deliver them directly to clients anywhere in the world, or we store it within London bullion market approved vaults, again, in a variety of different jurisdictions across the world. The storage vaults that we use are London bullion market approved. They're stored on a fully segregated, fully allocated basis, and fully insured by the Lloyd's of London. And I guess what makes us uniquely different is the fact that we apply a consultative approach to clients buying or selling metal. We tend to have a vested interest in the performance of our clients' portfolios. And what I mean by that is the better we do, the better our clients do, the better we do in terms of our reputation. And the more you tend to see us in the top tier publications. So we often feature on CNBC, Bloomberg, BBC News as thought leaders for what we do within the space. And as much as we like to give guidance in terms of how to do this and why to do this, we often give guidance in terms of, when to do it or when not to do it, because there's always an optimum point in terms of when to purchase. And it's not so much about merely purchasing gold or silver. It's also about removing risk from a variety of different asset classes at the optimum point. So we often give timing in that respect, which would then seek to remove some of those risks while taking advantage of both gold and silver at the best possible price. The other reason why we are sought out by the professional market, the investment bankers, the accountants, the lawyers, who tend to want to purchase at the lowest possible price, but they often make a habit of removing any and all risk, is because we offer a buyback guarantee, which is particularly rare within our particular marketplace. And essentially what that is it's a guaranteed means of instant liquidity as of when a client requires it. Now, despite the fact that most people that purchase metals do so for the longer term today has a very different definition to what it did 3 or 4 years ago with the use of technology and globalization. Previously it would have been, 4 or 5 years plus. Now it can be anywhere from a year or 2 years plus. But our buyback guarantee works and is operative, immediately after you purchase. And it's important that clients understand that it's as liquid as any money or cash that you would have sitting in your bank account, but you're not exposed to some of the nuances that people are exposed to when they've got money in the bank, i.e. counterparty risk, inflation, low-level interest rates. But with your physical gold and with your physical silver, ideally you're growing your wealth in something that is physical, something that is tangible, something that tends to increase quite considerably in times of uncertainty. And if and when you need to liquidate, despite the fact that you can liquidate gold and silver anywhere in the world, in any currency, we offer a buyback guarantee for convenience. So essentially that is what we do. And what makes us different is the fact that we do this based on relationship. We provide that consultative based approach. We get to really understand why people are purchasing for the reasons they are purchasing for. That allows us to provide, I guess, guidance in terms of effectively what they should purchase and when they should do it.
Now that's very interesting. I'd like to sort of delve a little deeper into that level of service, if I may, Josh. I'm a former bank manager, financial advisor, and international wealth manager. I've worked in Switzerland advising high net worth clients. And one of the areas where I differed from perhaps some of my colleagues is that I've always recommended to people to invest somewhere between 5 and 10% of their portfolio in precious metals, and preferably gold and silver. Most of my colleagues didn't do that because, of course, they weren't necessarily remunerated for doing so. Whereas if they offered bonds or some form of regular savings plan, they were paid very high levels of commission, and they were paid virtually nothing for recommending gold and silver. And so most of them just simply didn't do that. Now, of course, if a client came along and paid you on the basis of a fee as opposed to a commission, then sometimes that differed. So what you're saying is you don't, unlike perhaps most bullion dealers who will just say, this is my gold, these are my gold bars and coins, these are my silver bars and coins, you can buy them at this price, here's the website, buy it from here. What you're saying is you go into a more detailed consultative approach and perhaps look at their portfolio and judge whether their proposed investment is sensible or not. Am I right there?
Yes, to a point. And I think, it's really important to mention that we're not financially regulated. So we're not allowed to give financial advice. We're not allowed to assess a client's risk rating and say that actually based on their level of risk, they should be doing this or they shouldn't be doing that. Our job is to give as much procedural guidance with as many facts as possible about the market, about our product, about pricing, so that clients can make their own informed decisions. So effectively, we give the information, and it's for clients to decide what they think is relevant to them. And it's really important that, we're not seen as financial advisors, and we make that really, really clear. But I think it's a really interesting point you mentioned about the regulated market, because essentially, financial advisors have to take out insurance, professional indemnity insurance. And what we've found over the many years that we've been doing this is that, we tend to get a lot of financial advisors that will recommend clients to purchase through us. And I would say that a lot of those financial advisors that make those recommendations do so ethically. It doesn't actually come through that financial advisor. And when I ask these financial advisors, why are you not arranging the purchase for them as opposed to just sending them our way? And what a lot of them say is that they're not actually insured to advise on what they would call alternative asset classes. Now, physical gold, as ironic as it would sound, despite the fact that, people have been using it for centuries as a store of wealth, is regarded as an alternative asset class in as much as physical silver is. And as a result of that, a lot of financial advisors, I would say 90% of them, they're not insured to give any financial advice on whether or not a client should purchase them. So in a way, the market is limited because they're only advising on the products that they are allowed to advise upon. And therefore, if they had to advise with their professional hat on, as opposed to their ethical hat, despite the fact the client wants to remove all and every counterparty risk, most financial advisors will turn around and they'll say, well, I think you should probably purchase a gold-backed or a silver-backed ETF, as opposed to, telling the client to go off and purchase the physical asset class, either on their own or through them. I think the other, once you get me started on financial advisors, and I know this is what you used to do, and I have some real respect for what you do, because it's a really, really difficult job. Some things you can control and other things you can't. And actually, some of our consultants used to be financial advisors in a previous life. If I ask some of our if I ask my clients, what their financial advisor's job is, they will tell us that, his or her job is to grow my stock portfolio as much as they can, right? And I would disagree. I would say that is not, their job. Their job as a financial advisor is clear. It's to attract balances to the institution to which they work, so to bring assets under their management. And it's to invest those balances in the market so that you can see it in the way they're paid. So most of these financial advisors, they're paid on assets under management, which means they get a percentage of the totality of the portfolio that they manage. And it varies, but most commonly it's about 1%. So, if we were to do a quick role play, right, and you're my financial advisor, I've got you're looking after about £1 million worth of my portfolio within the stock market. You're making about 1%. So effectively, you're making around £10,000 per year. Now, let's say for supposition, you're doing a really bad job. The market falls by 50% and I'm now down £500,000. Now, you're now earning £5,000 a year, right? So the idea is that as long as I stay in, whether I win, I lose, or I draw, you get paid. So what does it do? It creates conflict. Now, I've asked this question so many times that it becomes rhetorical, but I ask my clients, hey, did you get a call from your financial advisor before the crash in 2008 to say, look, I've looked at the charts. This thing doesn't look good. We've got to get your money out temporarily. And no, nobody got that call, not in 2008, not in 2000. And the reason for it is that, for a financial advisor to call every single one of their clients and say, look, we need to get your money out for a while, it literally stops their ability to earn. it literally takes food off their table. So those calls didn't ever come. And this is what we tend to see happening. The market drops by 50%. People panic. They call their advisor to ask them what's going on. And everyone gets a version of the same line back. And it's something like this, well, this was a broad crash. No one could have seen it coming to the extent that it did. And now here comes the line. But don't worry, the markets will come back. I'm sure you've heard it, everyone has. It's a very common phrase. And you know what? They're right. When they say the market is cyclical, we establish that. By that definition, it's going to come back. But the problem is, it's going to be in 7 to 10 years. So you think about this game, the passive reliant individuals playing, you ride the market up every 5 to 7 years. You take 2 steps towards retirement, the market drops, you take 1.5 steps back, and you spend the next 7 to 10 years taking that 2 steps forward, taking 2 steps forward again. And it becomes this kind of dance, 2 steps forward, 1.5 steps back. Essentially, you're taking half a step forwards every 20 years. You're essentially inching forward over time. There's something, the reason I mention this is because we deal with a lot of investment bankers, a lot of hedge funds, and a lot of smart money clients. And the way that they do things is slightly different to the way in which a financial advisor would advise their client. And we can come on to that later. But I just wanted to kind of address the question of the regulated market in the way that we see it in respect of our clients.
Oh, that's great, Josh. And frankly, I couldn't agree more. I've now technically retired from that world, so I cannot officially give investment advice today. I did point out, however, to our subscribers that I have quite a reasonable pension fund, which is heavily invested in equities. And in December, I converted more than 50% of that fund temporarily into cash with a view to putting it into alternative investments or waiting until the fall on the equity market, which in my personal view is inevitable and so far has occurred to some degree, awaiting an opportunity to invest back in. But you're absolutely right. Financial advisors in the main do not actually contact their clients and say, oh, we think you ought to do this. In fact, what a lot of them tend to do is apologize for the decline in the portfolio and emphasize the fact that over the long term, equities will be perfectly fine, don't worry. So you're absolutely right there. But talking on about investments, I'm going to play devil's advocate because gold is up just this week $70 and silver's up $1.40. Over the month, gold is up 9%, silver's up 15%, which is great. But if we look at a 10-year view, unfortunately, gold is up 17%, which when you compare that to the equity market, it's not good, in fairness. I think I'm right in saying Goldman Sachs claim that the average stock market rise per year is about 9.2%, and the S&P was over 13%. But silver's had a 23% fall over the 10-year period. So over a month, it's done well. Over a year, gold up 14, silver's down 1. But over 10 years, gold has done moderately, but 17% isn't something to jump up and down about. But silver's had a 23% fall. What say you to that?
Well, I guess I want to answer that with a question. Can I ask, are you measuring this increase in US dollars or sterling?
Yes. Good question. I'm measuring it in US dollars only because the majority of our listeners are from the United States. Having said that, we have a fair number coming from the UK, obviously from Australia, Canada, New Zealand, and other parts of Europe, with a few then further afield. I tend to price it in dollars purely because of the fact that commodities are currently priced in dollars. And I think I know where you're going to go with this, then talking about sterling in particular and how that's performed in other currencies. But by all means, keep this conversation as wide as you wish. But I focused on dollars, but if you want to widen that to other currencies, that's perfectly fine.
Well, we can start with dollars. I guess back in 2011, I remember back in 2011 in US dollars, we reached, I think we started at around the $1,370 an ounce mark. And if we're looking at today's price of around 1,941, I make that around a 41% increase. Obviously, 2011 was a very volatile year. We had a big range between the low and the high. I think in 1 year, in 2011, we saw an increase from 1,376 right up to 1,700. So I think, if we take the lower part of 2011, which was 1,376, and we take today's value, that accounts for a 41% increase in the value of the metal, which over 10 years is a 4% increase per year, which again, if you were to equate to inflation, it's exceeded inflation, which gold is supposed to do at the very, very least. But I get your point. I would say that compared to equities, it is probably underperformed. If you look at it in sterling, in the same year, 2011, the gold price was around £850 per ounce. And if we look at the gold price today at around 1,470, it's increasing at such a fast pace that I might be out of date based on me saying that. But broadly speaking, we're sitting at around a 73% increase over the last 10 years. And again, that accounts for, roughly speaking, a 7% increase per year. I would say that a lot of our clients are purchasing gold and silver for many more reasons than purely price alone. Effectively, our clients, and again, I mentioned this before, we service a lot of investment bankers, a lot of accountants, a lot of lawyers, because we get to speak to every single one of our clients. We really get to glean the underlying motivations for why they're looking to purchase. And when you've got the head of 3 different banks telling you that they're purchasing gold because they don't have much trust in retail banking, then it's a cause for concern. So I would say the number one reason for people purchasing physical metals is to remove a portion of their wealth from the banking system, from banks, from institutions, so that they've effectively got their own control, their own autonomy over their wealth. If we look at other reasons, we've got, we're sitting within a market that is riddled with uncertainty, full of unpredictability. And it's usually those sorts of markets that gold and silver tends to perform very, very well in. If we look at gold since the year 2000, we've seen, roughly speaking, a 500% increase in the metal. But again, most of our clients aren't doing it purely to make money. They're doing it as an inflation hedge. They're doing it to remove counterparty risk. They're doing it to obtain some sort of privacy within a market that is not private anymore. Purchasing physical metal, there's no requirement for you to register what you've purchased, where you purchased it from. There's no ledger that anyone maintains whereby members of the public can see what you own and what you have. And, that's become more and more of a factor, given that governments might decide, as desperate as they are, to wake up one morning and to slap a 40% tax levy on anyone that has more than a certain amount of money in their savings account. We saw it with Cyprus and Greece 5 or 6 years ago. And I would arguably say we are in far more desperate times today than we were back then as a world, as opposed to individual countries. So I think that those sorts of things are real drivers. And I think the other thing to not forget is that purchasing certain types of physical gold, depending on where you are in the world, will reward you with tax advantages. So let's say for supposition, the equity market, which has had a great run over the last few years. And I think last year, within my pension, I received around a 10% increase in the value of my equities. My gold, however, performed far better than my equities. But on equities, one has to pay tax. And with physical gold, if done in the right way, you're able to avoid paying any tax, legitimately speaking, which means that if you're earning 9%, depending on your tax bracket, you might only receive net 4.5%. And if you're earning 7% on your gold, if done in the right way, you're earning 7% net. So I think it's important that if you're purchasing the right asset at the right time for the right reason, and if you do it in the right way, you're able to achieve all of that upside in the same way as you would do with the equity market. And I think I'm a big believer that I don't think that any one asset should compete with one another. This interview or conversation shouldn't really be about gold versus equities or gold versus cryptocurrency or gold versus oil, because I think that there is genuinely a need for every single one of those asset classes within a portfolio. I have equities myself. I have cash myself. I've got gold. I think, the crucial element in terms of determining how much of it you hold within your portfolio is timing. I think timing takes a decision to do something or not to do something, and it will turn it into a good investment or a bad investment. Clients of ours don't necessarily look at physical gold and silver as an investment, because effectively when people invest, they're assessing how much risk that they want to take on. And when people purchase physical gold and physical silver, essentially what they're trying to decide is how much risk do they want to remove from a physical context, if that makes sense.
Oh, it does indeed. And again, I agree with you. I have to admit, though, you're taking the fun out of this for me, because I love comparing one asset class with another. And a lot of our subscribers will be very much aware of the fact that I occasionally tease them with cryptocurrencies, which most of them actually loathe. But at the same time, having said that, one cannot, for the short term, argue cryptos have generally performed and outperformed all other asset classes, even though they've taken a sudden sort of slump in recent weeks. Having said that, though, what does fascinate our members is this interrelationship between gold and silver. And we saw, I think, was it last year or the year before, the gold to silver ratio rise above 125, I think, if memory serves me correctly, at one point. It's now resting or move between sort of 75 to 80 to 1. Where do you see that readdressing in the years ahead? Is silver going to gain a march on gold, or is it too difficult to tell?
Well, it's a difficult thing to accurately predict any market at the moment. What I can tell you is that, most of the experts and commentators within this space would say that, the two metals should be trading within a ratio of around 12 to 1, 12 to 15 to 1. That was the relationship between the two metals for many, many years. And then, of course, we saw gold shoot up in 2006, 2007, and it left silver behind. And if I'm being completely upfront with you, silver has been completely underwhelming in terms of performance. We've all been kind of waiting with bated breath for silver to amplify as we expected it would. Most people, they value the fact that silver should be trading at least by about $100 an ounce relative to where the gold price is at the moment. Silver is used far more within industry than gold, because it's used within, conductors, it's used within technology, catalytic converters, photography, medicine. I think the big contributor, and I think the big difference over the next 10 years as opposed to the previous 10 years, is the fact that most countries around the world are so conscious of their carbon footprint, in that I would say most cars over the next 10 years will probably be electric. And so many of those components within those cars have to be silver. You know, there's no other conductor other than silver within those lithium batteries. So I would say that, and I know we've heard this all before, but I would say that the one big difference between now and then is the space that we are moving into in terms of, you know, most cars on the street being electric, and therefore having demand for silver from an industrial point of view for getting investment for 1 second. And I think, you know, a lot of our clients have been very excited about silver. You know, we've seen a lot of the central banks and a lot of the institutions, JP Morgan, HSBC, they've purchased a lot of physical silver, and very quietly. There's obviously lots of manipulation within these markets, but they're clearly purchasing silver because they see a very good reason to do so. And, you know, we've heard all sorts of rhetoric that, you know, in 10 years' time, there won't be enough physical silver to satisfy, you know, industrial demand, like the requirement for cars and batteries and what have you. And I guess I see it in a very similar way to what we saw gold, the price of gold back in the 1970s. You know, 1 minute it was $20 an ounce. And then all of a sudden it jumped to 75, all of a sudden it jumped to 300, all of a sudden it jumped to 800. And you look back and, you know, the gold price increased thousands and thousands of percent. And I would say that there is little risk in applying the same sort of blueprint to silver as a metal as it becomes more affordable. It provides the same sort of hedge against inflation that gold does, but it's used within industry far more than gold. And therefore, I believe, and I believe a lot of experts and commentators believe, that silver has the ability to do well during times of unrest, given that it tracks the price of gold, but it also has the ability to do well in times of prosperity, when demand for manufacturing and cars is very high. So look, if you were ever going to buy an asset class, you would want to ensure that, relatively speaking, you were buying at the bottom of the market. And I think, you know, when you talked about the silver price, you know, back in 2011 to the silver price now, you're completely spot on. I think, you know, but in US dollar terms, the silver price is 50% cheaper now than it was back in 2011. But the fundamentals that support the silver price increasing, I would say, are 10 times stronger today than they were back then, which surely makes, you know, it paves the way in terms of taking advantage of a massively undervalued asset class with, I believe, longevity. And you know, we've been having lots of conversations with clients at the moment, and our conversations aren't always about, you know, you should be buying gold or you should be buying silver. You know, it's far more of a holistic conversation about, right, well, what are your alternatives? You know, we're living in an environment whereby we have undeniable geopolitical risk. And, you know, that existed back when Korea were arguing with the US, or the US were arguing with Korea, whichever way you decide to look at it. We're now seeing it with Russia and Ukraine. You know, we don't know how bad that is going to get, and you know, how much that amplifies within the market. We've got inflation at a 40-year record high. And depending on which metric you decide to use, CPI or RPI, what I can tell you is that both of those measures don't include things like construction costs that are now 30% higher than what they were 2 years ago. And I believe it's a relevant point, because everyone needs to repair things in their house. And, if you need to use disposable income to do that, then all of a sudden that's 30% more expensive. They're going to have to put up rates in most countries to control inflation. And they're talking about, especially in the UK, putting it up to pre-crisis levels of around 5%. So if they do that, effectively people's mortgages are around 500% more expensive than they are at the moment. You stick that in the basket of goods and services, again, that inflates inflation far more than the 5% guidance the government are giving. Then you take into account property prices, rent, or to buy a property. That's gone up far more than what they've guided inflation to be. Petrol prices, energy, people are expecting energy prices to double in various countries. So, a lot of experts suggest that actually inflation should probably sit conservatively at around 9 or 10%. So in order for anyone putting their money in the bank, for them to earn a real rate of return, interest rates would have to be 9 or 10%. For that to happen, I believe debt would become almost 1,000% more expensive. For me, I couldn't stomach my mortgage being 1,000% more expensive. I'm not quite sure what we would have to do, but most people would have to sell their houses because, effectively it would be cheaper to rent than it would be to pay your mortgage, to pay your debt off. So this comes back to looking at what are the alternatives? Do I keep money in the bank that's earning less than 0.5% with inflation either at 5%, which is what is reported, or at 9 or 10%? By doing that, effectively, you are losing money every single year, and not slowly anymore. So if you've decided, well, you don't want to keep it in the bank, not just because of inflation, but also counterparty risk is high. Banks, some of them anyway, are not in the greatest of positions. A lot of them don't have the right sort of capital adequacy ratios. Well, then what's your next option? And in no order of preference, people may well look at property or equities or cryptocurrency. So, if we're looking at property, well, look, property is a great asset class. It's something that provides income. It's something that, we all need in terms of a roof over our head. But in terms of timing, the property market is the highest it has been in over, well, forever, actually. Is it high because there's a finite supply of property, or is it high because we have had record amounts of debt being taken out by people that probably wouldn't be able to afford it if interest rates were to increase? And I think regardless of that answer, they're stopping to, as they start to put up interest rates, less and less people are going to take debt. And with less debt will mean less property purchases. With less property purchases, that slowdown will start to increase. And if you factor in the fact that people may well start to default on some of their debt, or unemployment might increase because of what we're seeing, then more people might have to sell. And the combination of those two variables will mean that property prices could come down. Most of our clients, and we have lots of property developers, see more downside risk in the property price decreasing than increasing. Again, I see it as a real opportunity at some point in the market. I don't see the opportunity right now. And it's not as liquid as, let's say, equities or cash or physical gold. So when we then move on to, let's say, the equity market, this for me is particularly interesting because, again, we have lots of clients that when they're purchasing gold, they're considering these other contemporaries, like equities and like property. And with equities, the S&P 500, the Dow Jones, we've enjoyed the longest bull run in over 200 years. We accept the fact that the equity markets tend to correct themselves once in every 7 to 10 years. So we are around 3 to 4 years overdue a correction purely based on timing. But if we look at, let's say, price to earnings ratio, the price to earnings ratio at the moment is around 33 times, which is the highest in history, bar no event. And what we've seen is that if you look at the price to earnings chart throughout US history over the last 140 years, if you were to draw a line across that chart, what you will see is this. Every time throughout history over the last 140 years, whenever the price to earnings ratio has hit 27 or higher, we are followed by a monumental crash. We saw it in 2008. We saw it in the year 2000. We saw it in the year 1987. And I think the year 2000 is an interesting one because effectively, what we saw, what we saw back in the year 2000 is the birth of a lot of the tech stocks, the dot-com bubble burst. And this is when we saw, Facebook weren't even in existence. These companies had really large captive audiences, but they hadn't effectively monetized them yet. So the point is, analysts were giving them these crazy valuations above and beyond their earnings because they understood future potential, but the money wasn't there. And the point being, they couldn't really value them. And, now with the likes of Amazon and eBay and all these other fintech companies, exactly the same thing is happening as we speak. And, as I was saying, if you look at the price to earnings ratio chart over the last 100 years, if you were to take that pen and draw a line straight across US history, you will see that without one historical exception, whenever the price to earnings ratio hits that 27, we've been followed by over a 50% crash in the stock market. And there are literally no exceptions in history. So I guess going back to what we were talking about in terms of equities performing to 9%, I would say that is amazing. We've been able to do that. Why have we been able to do that? Well, I think fiscal policy has a large part to play in that. We've had record low interest rates. We've had money printing, which has contributed to a huge inflation of the stock market. We've also had an enormous amount of corporate buybacks, whereby corporations have used free money from the money markets to buy back their own stock, which therefore inflates their stock, makes the stock market seem bigger than it actually is. But I would say that all of this amounts to the fact that we're on borrowed time. And it might be tomorrow, it might be a week, a month, it might be a year. But if you look at what the smart money are doing, and if you have a look at, let's say, the smart money flow index, you can see institutions selling and removing exposure from these sorts of markets in earnest. And you can see that, the smart money, they don't tend to do this dance of, 2 steps forward, 1.5 steps back over 20 years. And the reason for it is that, they advance 2 steps forwards and they may well have liquidated prematurely, but for them, it's about being able to take advantage of a variety of different markets and cycles at the same time, instead of, moving 2 steps forward, 1.5 steps back. And that's what we're seeing at the moment. And, just to kind of, to finish this kind of comparative analysis off, a lot of people don't even spend much time talking about bonds or gilts, because effectively you're locking yourself into a vehicle whereby you are guaranteed to lose money over a 10-year period. And there's not much you can do about it. Now, cryptocurrency, I think the notion of cryptocurrency is quite amazing. It really is. What has been created and invented over the last 10 to 12 years has been quite fascinating. And I do believe crypto is here to stay. What I would say, however, is that it's not established. It doesn't have a track record in terms of safety and security in times of uncertainty. It is highly, highly volatile. And that may well be to your benefit. We've heard of amazing stories where people have made thousands of percent within a really short period of time. Unfortunately, people have also lost a lot of money by trying to ride those gains, purely because no one's able to see the volatility coming. Sometimes, they operate within a realm of their own. So when we get to looking at, what asset class to put your wealth into, it's a question of, well, if I've taken away all of the other alternatives, but I need to do something, gold and silver in its physical form tend to present an asset class that tends to increase in times of uncertainty, something that keeps pace with inflation. Let's not forget that the definition of inflation is that is the rise in cost of commodities and services, and by definition, gold and silver is a commodity. So, again, by definition, gold and silver keeps pace. And even if, let's say, we've seen a lot of this over the last couple of years, clients aren't necessarily convinced that they want to be in the gold and silver market long term. They may well want to purchase property, but they want to wait for it to become, present better value at a lower price. They may well wish to buy into the equity market if and it corrects itself. But what do they do whilst they're waiting for that particular point in time? And a lot of these people put their wealth into physical gold and silver through nothing more than a holding pattern. And I think, during this kind of modern era of uncertainty, physical gold and silver have been used as a long-term store of wealth, but also a temporary holding pattern for investors or everyday people or clients to decide what it is they really wish to do with their wealth.
Josh, you've been very generous with your time, but I would like to ask you two more questions, if I may. The first one is a softball one, really. So I'm here now thinking, shall I invest in gold and silver now, bearing in mind both of them have risen quite substantially in the past few weeks, partly because of the Russian-Ukraine situation, partly because of the rather high levels of inflation, or CPI, as they call it in the United States. Should I perhaps not wait until, because we're going to have rising interest rates, the Fed's likely to raise rates in the middle of March. The Bank of England's talking about a third interest rate rise in March now, because we've had one in January and February. And of course, when interest rates go up, that tends to have a dampening effect on commodity prices. So should I wait until those interest rates take place and wait until the war or the incursion with Ukraine is over? Because if that happens, surely gold and silver prices will fall. How would you answer that?
It's a really good question. And, no one has a crystal ball, and it's impossible to predict, first of all, what governments are going to do, what markets are going to do, what markets are going to react to what governments might do. Obviously, we can use what has happened before as a bit of a guide, but we're sitting in uncharted territory. So the first thing is that the government's decision to push up interest rates in the face of being able to control inflation, that was all decided and planned before they were aware that Russia would invade Ukraine, and before any sort of consequence as a result of any other country getting involved might ensue. So, that wasn't factored in. And I believe, and I wouldn't be surprised if come, the later part in March or April, various governments decide to hold off increasing interest rates so as to remove some of that volatility within the market on account of what we're seeing with regards to Russia and Ukraine. The other factor is this. In 2015, we saw a similar issue in the US. They decided to put up interest rates for the first time in quite a long time. And I remember back at that particular point in time, the much debated topic was, well, if we put up interest rates, that is going to strengthen the dollar. It is going to weaken the value of gold and also silver. So therefore, we should wait until that happens. And if you go back to 2015, what you'll see is that when they increase interest rates, their debt became more expensive. The ratings on various bonds decreased, and the US basically had to make a U-turn on their interest rate because the market couldn't handle it. So when they made that U-turn, you'll see that that was the beginning of gold and silver's ascent up until today. I think by waiting, which is clearly an option, what you are not appreciating is what you are removing risk from, because waiting until they increase rates does not reduce risk from a counterparty point of view. I believe that if they were to increase rates, it is going to put far more strain on homeowners, debt owners, and governments that have to repay debt, and whether or not they do it or not. And at that point, you might see the gold price increase as a result of, you know, people struggling with their own finances and markets becoming even more unpredictable. I would also say that the markets are relative. We never know what's going to happen. And back in 2007, when we had what was coined the credit crunch, and back then as well, we had, you know, the various wars on terror and Afghanistani interventions and what have you, the same conversation was debated at that particular point in time. You know, the gold price has increased 50%. Should I wait for it to come down, or should I purchase? Some people waited. Some people waited for 3 years because the gold price continued increasing to a point where it increased by 330% over a 3 or 4 year period. What we tend to say to our clients is that in the absence of not knowing one way or another, it makes sense to hedge. No one knows. We're all surprised by the unsurprisable. And actually, the only thing that's become more or less predictable is unpredictable markets. So with that being true, hedging yourself, you know, if a client, if you've got £10,000 to put into physical gold and silver, you know you want to do it for the various reasons that we've already outlined, but you're just not quite sure about price at this point in time, the safest thing to do without gambling away would be to purchase some now and then some at a later date. Rely on some of our guidance for timing, because we don't have our only vested interest in terms of timing is for you to do as well as possible. You know, we're not selling stock, we're not a shop. So whether or not you buy when the market is high or whether or not you buy when the market is low makes no difference to our margins. So it only works for us if you buy low and you sell high, because it means that our reputation is enhanced as a result of it. Excuse me. The other thing I think is worth taking into account, and this is where we really hold our own in terms of our consultative approach, is that it's not all about the gold and the silver price. You know, you're purchasing a physical asset class, which means that premium has to be taken into account. And premiums fluctuate. You know, premiums will fluctuate based on a variety of factors: supply, demand, inventory requirements, logistical supply chain. And just because, let's say, the silver or the gold price has come down, if more and more people are trying to acquire that physical metal, then premiums might increase, which therefore might mean that you end up paying more despite the gold or silver price coming down. So what we try and do is we try and create an environment whereby you've got harmony between the silver and the gold spot price, but also the buying and selling premiums, because effectively that is what is going to enhance your buying price for the metal in which you acquire.
Josh, that is great. Final question for you then. Basically, I mentioned earlier that we have subscribers and followers from all over the world. Are you able to cater for all of their needs, almost regardless of which country they come from? And if that's the case, we will be providing a link to your website. Can you just go through the process of what actually happens if someone makes an inquiry? And for those who perhaps fear the fact that, oh, if I phone, I may be obligated, can you put their mind at ease, please?
Yeah, perfect. So the first thing to answer your question is we can help everyone. The first need is talking to us with no obligation nor any commitment. You'd be surprised. We've had conversations with people whereby we said, you've got the right idea and the right inclination. Timing's not right. Come back to us in 3 or 4 days, come back to us in 2 or 3 weeks. Sometimes the client circumstances don't necessarily warrant purchasing physical gold and silver, especially if it's, ultra short term, for example, over, a week or 2 weeks. So what I would say is, get in touch with us. We have qualified consultants that come from a variety of different backgrounds. You can have a conversation with them. They will give you procedural guidance in terms of how it works, how the market works, timing. The conversation can be as detailed or as brief as you like. And this isn't for us to sell metal to anyone. We have, our turnover is increasing phenomenally, but we have an inbound approach whereby we don't cold call any of our clients. For us, it's a question of assisting people who wish to make a purchase. So as far as we're concerned, we want to give you as much information as possible so that you feel informed making some sort of a decision. So, if you've decided that this is the route you wish to go down, then we'll ask you to complete an online purchase order. We don't accept card or check, and that's a benefit for our clients because we're not regarded as a money dealer. And because we're not regarded as a money dealer, we don't have to account to HMRC for every single one of our clients purchasing metal from us, which I understand the other providers have that obligation. So funding your account will be by way of a bank transfer. Clients will then decide exactly how, what they wish to purchase, in what denomination, whether or not they want delivery directly to their door, or whether or not they want to take advantage of secure and assured storage. All clients get a transaction invoice, a certificate of authenticity, which verifies the weight, the purity, the gold or the silver content, and that includes our details on our buyback guarantee. Clients are able to obtain valuations at any particular point in time. But I would say that, if there is an inclination to find out more, I believe that in this particular market, knowledge is absolute paramount. It's key. So get in touch with us and, the rest will make sense after that.
That's tremendous. Josh, thank you so much. Any last words or anything perhaps we've not covered you'd like to sort of leave with our followers at all?
I think we've covered most of it. I would say that the other thing that I would say is that sometimes, gold has become more expensive. Silver is becoming more expensive, as we've seen a 15% increase. And we've got a really exciting product called the accumulator, whereby clients are able to, if let's say for supposition, they're not purchasing as a lump sum, they can create a plan whereby we withdraw money every month, and they are sent either gold or silver coins every month, or it's stored in their vault. And the beauty of this product is they can cancel it at any time. They can pause it at any time. There's no commitment. But, we've had clients that have been doing this for, let's say, 4 or 5 years. And as a rule of thumb, if you're saving £500 per month, over a year, that equates to $6,000 or pounds, right? And over 5 years, effectively, you've got around £30,000 or dollars. Now, if the experts and banks and commentators are correct, and over, and if over the next kind of 5 to 7 years, we see the gold price and the silver price do what it did between 2007 and 2012, whereby it increased by 330%, then, all of a sudden, you've got a portfolio that's gone from 30 up to, let's say, 75, taking into account the various different price points in which you purchase. So signing up for an accumulator, if you think that, let's say, you haven't got enough money to purchase a lump sum, is a really good way to get started within, this sort of a market, especially as the gold and silver price continue to increase.
Josh, thank you so much. Really appreciate your time. As I've said, we'll put a link below to the site, and anyone interested without commitment can just make a basic inquiry. Thank you once again. My pleasure. Silver owners come from a background of banking, international wealth management, and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.